Chapter 11, we've got two parts. The first part is going to cover direct materials and direct labor variances, and part 2 will cover overhead variances. Now, I just want you to know that I have tried to walk you through this as much as I can because, boy, it's all about picking the right number to make this all come out. So, I have tried to do that and explain it as best I can because I've always felt that this is one of the challenging chapters for students. So now we're going to look at, well, what is a standard? Well, we have talked about budgets. Budgets are total costs. A standard is an estimate of what it costs to make one unit. Now, of course, that's going to be made up of direct materials, direct labor, and overhead. Now, standard costs, they're based on carefully predetermined amounts used for planning labor, material, and overhead, the expected level of performance, and benchmarks for measuring performance. They have three different. We have the ideal, which is everything's perfect, which it never is. Perfect standard, that's used under lean production. And then, of course, we have the realistic practical standard, which allows for normal waste and inefficiency. Now, when we look at standards, we're looking at two things: quantity standards and cost. So, did we use more or less than we should have? Or did we spend more or less than we should have? That's what we're talking about here. Now, standard cost variance is the amount by which an actual cost differs from the standard cost. And we do standard costs for direct materials, direct labor, and manufacturing overhead. Now, on top of that, we measure 2, 4, 8 variances. Material variance, we've got price variance, and we've got quantity variance. Labor, we've got labor rate variance and labor efficiency variance. And then overhead, we break it into two parts. We have the variable variance, which has to do with our overhead rate variance and our overhead efficiency variance. And then we have our fixed variance, which only looks at our fixed costs, which is the overhead budget variance and the overhead volume variance. So now we'll go through, and like I say in this presentation, part 1, we're going to look at material and labor variances. So here's the thing to remember. The reason we break it down like this is we're trying to get closer to who is responsible if we end up having overspent, not getting the bottom line we expected. So price and quantity standards are determined separately for two reasons. The purchasing manager is responsible for raw materials, and the production manager is responsible for the quantity. The buyer and using activities occur at different times. Raw materials purchased may be held in inventory for a period of time before being used in production. In this case, let's first go to our direct material variance. Now, how much of total variance is due to paying a higher or lower price than expected for our direct materials? And remember, it's purchased, not used, because they're going to give you both. So we're going to take our actual quantity purchased times the difference between the actual price per pound, or whatever you're buying in quantity, and the standard price per pound. So we're going to look at the same example through all of these variances. And here it is. So first thing we're going to do is the direct material price variance. The direct material price variance is, again, the actual quantity purchased times the difference between the actual price versus the standard. So in our example, we need to remember it's the purchased. And then we're going to take our actual minus our standard, and that tells us that we are unfavorable by $8,910. How do I know it's unfavorable? Well, I'll tell you why, because we paid more per pound than what we had for the standard. Now, one of the reasons they could have done this is maybe they made the assumption when they paid a little bit more, that maybe they might use a little bit less, and therefore they would save costs even though they paid more. This would be something to talk to the purchasing department about. Now, the direct material quantity variance. How much of the total variance is due to using a larger or smaller quantity of direct material? That's going to be the standard price times the actual quantity used minus the standard quantity that should be used based on the actual units produced. So there's your standard price, actual quantity used, and the standard quantity per unit times the actual units produced. That's what we're going to use here. Now, my suggestion is when you go to do your homework, write down the formulas because then you can find what you're looking for. Now, here's our example. There's our formula. So we're going to take our standard price again times the actual quantity used minus the standard quantity per unit times the actual unit. So here's what that looks like. We took the $3, which is our standard, the quantity used. Remember, it's not purchased in this formula, it's the quantity used. And then we're going to take the standard pounds per unit times the units produced. And the difference is also unfavorable. Why? Because we used more, $1,120 more than what we had budgeted based on the standard. Now, this means that the production division used more materials. So maybe possible explanation is they paid more for the material in hopes they'd use less, but it didn't turn out that way. Now, I'm not saying that is the answer, but I'm saying it could be. Now, the total direct material variance is 12,270 unfavorable. Who's responsible? Well, you'd want to talk to the purchasing department for this and the production department for that. Now let's look at the direct labor variance. We have two, the direct labor rate and the direct labor efficiency variance. Our formula is actual hours times actual rate minus standard rate. So again, here's our formula. Then we're going to go find that information. Actual hours is there. Units produced equals 8,800 hours. And then our standard rate per hour is 19. Our actual is 18. So we have a favorable variance of $8,800. So what we did is we maybe used newer workers so we didn't have to pay as much. So we'd have to discuss that with human resources. Now we have our direct labor efficiency variance. How much of the total cost variance is due to using a greater or lesser amount of time? So here we're going to use our standard rate, actual hours times units produced, minus standard hours allowed, which is the actual units produced times the standard hours per unit. Go to our problem. Here's our formula. Now we're going to get that information. We get the $19, which is the standard, times the actual hours, times the units produced, which tells us that's 880 hours. And then we're going to take the number of units again produced times the standard. And we get an unfavorable variance of 15,200. Now, we have an unfavorable variance because we used more hours than the standard hours per unit for the amount of units produced. This needs to be discussed with the production manager. What is the total direct labor variance? We have favorable minus unfavorable, which gives us a total of $6,400 unfavorable for direct labor. Now, the direct labor could be tied to, i.e., we got different materials. Maybe it took more time to make them, but it also looks like maybe they got cheaper labor that had less experience. So we have a learning curve. So where do we go? When we have direct material variances, it's the purchasing supervisor. If we have direct material quantity variances, it's usually the production supervisor. If we have direct labor rate variances, it's usually human resource and the production supervisors because they made a decision to get cheaper labor. And the direct labor efficiency variance, again, would be that production supervisor. That ends this part 1 of Chapter 11.